We're about to head into another round of banks reporting, kicking off next week. We'll have Westpac on the 3rd of May, ANZ on the 5th of May, NAB on the 6th of May, and then CBA will have a quarterly trading update for the March quarter on the 13th of May. Just heading into this round of reporting, yet again, we appear to have the most optimistic earnings forecast on the street for every major bank. And yet again, the differences between us and consensus appear to be on bad debts and net interest margins. Now, it's not a position I'm deliberately trying to have. It's just panning out that way. I'll touch on asset quality because this is really where the big differences are between myself and consensus. To give you some idea of the difference there, for each of the next 3 years, we're forecasting a bad debt charge generally of less than $300 million for each year of the next years for every major bank, whereas consensus has got something in excess of $1 billion. So what consensus is implying is that provisions will continue to build for the banks. So consensus is suggesting the provision build is not done yet. There's more to come. I really don't know how that can be justified for me. That's just way too pessimistic. I think my forecasts are conservative enough, and even then, I'm arriving with numbers far more optimistic than consensus. So, in terms of the basis of my modelling on the bad debts, at a high level, I'm not assuming that provision coverages go back to pre-pandemic levels anytime soon. And I'm really thinking about it in terms of collective provision coverages of risk-weighted assets. Pre-pandemic or just before the pandemic, those coverages were less than 100 basis points. In my forecast, I'm assuming they won't fall below 140. So at their peak, the banks have taken them up to about 155, 160 bips. And I'm assuming they won't fall back below 140 for the moment. So I think that's conservative enough. Now, a lot of you are very familiar with my views on asset quality and the outlook, but what I want to talk about is some of the more recent developments, particularly since the banks last reported their December quarter results. So they last reported in Feb. Since then, we've seen, positive developments on the asset quality front as well. We've seen a targeted stimulus package for the tourism industry. And so when the banks were last speaking to us in February, they were saying that they were worried about what would happen to the tourism sector once JobKeeper rolled off. But hopefully this targeted package has alleviated some of those concerns. We've seen a revised coronavirus SME loan guarantee scheme from the federal government, which the banks are far more excited about. And it looks like the take-up will be better than the first version or the first 2 iterations of this SME loan guarantee scheme. So that's supporting the SME asset quality outlook as well. The banks in February were also suggesting, and I agreed with this, I still agree with it, I think there will be an uptick in arrears, in home loan arrears in coming months. So we've seen the end of JobKeeper, we've seen the end of loan deferral periods. So I think it is reasonable to expect an uptick in arrears, and I do expect that. The only question is what will be the extent of that. I don't think the extent will be worrisome. And obviously, even if there are arrears, at this stage, it doesn't look like it will translate to meaningful losses given what house prices are doing, because those collateral values are so strong. Even if banks have to foreclose in certain cases, I think the collateral there is enough to make sure there's no loss on the loan. But in terms of what the banks were saying, a couple of them, particularly NAB back in February, they were sounding a little bit worried about what home loan arrears might do, and they were choosing to be conservative with their provisions for that reason. But what I've noticed since then is that a lot of the major banks have been repricing down the warehouse facilities that they've been providing to non-bank home lenders. And in some cases, those facilities have been repriced down from about 150 bips over swap to 120 over swap. And what that suggests to me is that the banks aren't too concerned about an uptick in home loan arrears. Otherwise, they really wouldn't be pricing down those facilities to that extent. At the same time, we've seen some significant contraction in RMBS spreads, which also says that the RMBS market isn't too concerned about the arrears outlook either. So all in all, look, I think consensus is looking too pessimistic on asset quality. I think we're conservative with our forecast, but we're way more optimistic than the street. On net interest margins, again, we're more optimistic than the street, not just for this year, but for the next couple of years as well. I completely appreciate that there's 2 big NIM headwinds still in place. Those 2 headwinds being a low rate environment, and secondly, there's very intense mortgage competition. But I'm seeing enough offsetting tailwinds, at least for the next 6 months, Those tailwinds include continued growth in low-cost deposits. I think some of my competitors have concluded that the growth in low-cost deposits has come to an end, or it won't be as strong as what we've seen over the last 12 months. But I'm thinking that conclusion is possibly a bit premature at this stage, because it's just based on one data point for the month of Feb. In Feb, in seasonally adjusted terms, is a low growth period for deposits anyway, particularly transaction deposits. But my view there is, I think it's quite possible that as long as the RBA continues with its government bond purchase program, I think we'll continue to see narrow money expansion, and that should translate into M1 expansion, which is effectively transaction deposit growth. So I think it's quite possible that deposit growth can remain strong as long as the asset purchase program is in place. And I think it's quite possible that deposit growth can remain strong even with the savings ratio coming down, because it possibly means that the money multiplier increases. So we've got this tailwind of low-cost deposit growth. Secondly, the banks still have got access to the RBA's term funding facility, and the bears might say, well, that's ending on 30th of June. What happens beyond that? To which I would respond, the RBA updated us earlier this month. They said $95 billion has been drawn on the TFF. $95 billion is still yet to be tapped. So I think as we get closer to the 30th of June, the banks will be tapping those undrawn amounts such that they've got enough funding there for really possibly 6 months beyond the 30th of June. And so what will happen is we'll get to the 30th of June, the TFF will end, but the banks will have drawn down quite a bit, parked it into liquid assets. And then what will happen over the subsequent months is that as term wholesale funding matures, the banks will refi that with this TFF funding, which they had temporarily parked into liquid assets. Also, we've seen a continued decline in swap rates, so I think there's a little more of a tailwind from that to come through as well. But the point I'm making is that, yes, there's two big NIM headwinds in place, but I'm seeing enough offsetting tailwinds there. And I think that's what the bears are missing at the moment. Some of these tailwinds, they're focused more just on the headwinds. So that's asset quality and NIM covered. They're the two key things I really wanted to talk about, because that's where we're different from consensus. In terms of our pecking order now, ANZ is now the number one, Westpac number two, NAB number three, and CBA remains least preferred. Now, in terms of the top two there, ANZ and Westpac, there isn't too much of a difference. I mean, ANZ's just edging out Westpac on a valuation basis at the moment. In terms of quality, I would rank Westpac above ANZ. In terms of risk profile, I would rank Westpac above ANZ. But, looking at valuations, ANZ is looking the most attractive at the moment, but it's only just edging out Westpac. So Westpac hasn't been demoted because there's anything fundamentally wrong or our view has changed in any way. It's just a valuation, on a valuation basis.